Okay, so in this video we're going to be looking at a simple pullback trading strategy. This one's going to be for the S&P 500 ETF, but you might want to use it on different markets. You might want to adapt it. I'm just going to show you the rules and the results. So first of all, bit of a disclaimer. At the end of the day, when I create these videos, I just want to provide you some ideas and show you what would have happened if you had traded these ideas in the past. So always remember, trading is extremely risky, and simulated performance results have certain limitations. They're not actual trading, and you never really know whether a trading system is going to continue to work in the future. Okay, so what I'm going to do now is just show you this simple trading strategy. Basically, we're going to be looking at pullbacks. So we're going to want a longer term trend, and we're going to want a quick pullback within that longer term trend. Longer term trends often, when you buy a breakout, you often get a whipsaw. So if we look for a little pullback, we might be able to reduce those whipsaws. So this is a daily trend following system, simple rules, and really it's designed to take chunks out of the main trend. So if you've got a fundamental view of a market and you want to take some pips or some points out of the main trend, this is a good strategy to use. It's got a short holding period. It's also good for walk forward analysis because we've got a lot of adjustable parameters that are very easily adapted for walk forward analysis. As I said, the idea is to get fewer whipsaws and a higher win rate. And this one, actually, we're going to see a high win rate of around 75%. So, all right, so now let's look at the exact rules of this simple pullback strategy. So the buy rules, first of all, we're going to want a close above the 200-day moving average and a close below the 10-day moving average. So very basic rules. The longer term trend is the 200-day moving average. We want to be above that, but we want to close below the 10-day moving average. So we've got a small pullback within the longer term trend. Now the sell rules are extremely important here. We're going to sell when the close rises back above that 10-day moving average. So we're not looking for long-term trades here. We're just looking for short-term trades, short pullbacks. And the other rule is we will sell if we get a 10% loss. So if we get a 10% loss, we're going to exit on the next bar open. Okay, we need some more settings that we can put into our backtester so that we can run an accurate backtest. So position size, we're going to use just 100%, no margin, 100% of cash of our starting capital, which will be $50,000. Commissions, we're going to set at 0.005 cents per share, which is what you get with interactive brokers. Execution, all trades are going to be placed on next market open. Basically, that includes the stop loss. So when we hit a 10% loss, we're going to exit on the next day open. This really is just a way to make a more accurate backtest with the data. Intraday exits can be a bit problematic due to where the data comes from. Okay, system notes. No real notes for this particular system. It's quite a simple pullback strategy. Test universe, we're going to be testing on the SPY, the S&P 500 ETF. We're going to be going back to 1995, so a good amount of data there to test with. And all our data comes from Norgate Premium Data, which is a good, clean provider. Highly recommend them. And we use AmiBroker for backtesting. So here's an example trade setup we're looking for. You can see SPY ETF. We're about middle of May 2017. You can see that we've dropped below the 10-day moving average, which is the blue line. We've closed well below that, but we're still well above the 200-day moving average. So that's our buy entry. So we go long on the next open, and as you can see, a few days later, we move back above the 10-day moving average. So we're then going to exit on the next open, which is the red arrow. So as you can see, we've captured a nice profit there, which is actually 1.79% before fees. So you can see we've only been in the trade a few days, but we've managed to get a profit of 1.79%, which is not too bad. Okay, so now I'm going to go into AmiBroker. This is what I use for all of my back testing. Use AmiBroker with data from Norgate. It's pretty good setup, very easy to run, very simple to use. So I've got the code, which I've coded in. It's just a case of bringing up the SPY ETF and running a backtest on this for the dates that we want. Now, the first thing I did for this particular strategy, I always leave some out of sample data first. So the first thing I did was to test on an in-sample period between 1995 to 2010. Quite a long in-sample period there. But and then I tested it on out-of-sample later. So in the in-sample period between 1995 and 2010, we got a net profit of $115,572. That came from 229 trades with an average profit per trade of 0.53%. Now that equates to an annualized return of 8.31%. And we've got a maximum drawdown of 9.43%. Our win rate was really good at 76.86%. And the average trade length was 5.27 bars. So then I ran this same system again, but this time I ran it on out of sample data, so clean data that I've reserved for verification. This was between 2010 and 2018. And we've got a net profit again. This net profit was $31,524 from 163 trades. We've got an average profit per trade of 0.31%, and that equates to an annualized return of 6.31%. Drawdown was slightly higher, win rate was slightly lower. So you can see we've got a profitable result in the out of sample. It's slightly worse than the in sample. That can be expected. So overall, not too bad result for just a simple test. So the next thing I did was I ran a full sample test, so on all of the data, and I compared that to buy and hold. So if we now look at the full sample, we've got between January 1995 to January 2018, and we've produced a net profit of $220,000 across 392 trades. Again, PL per trade of 0.44%, annualized return 7.61%, maximum drawdown minus 12%, win rate 75%, average bars held about 5 bars. So if we now compare that to buy and hold, we have got a lower net profit than buy and hold, and annualized return is also lower than the buy and hold return. However, the really important thing to look at here is the risk adjusted return. So if we look at the maximum drawdown, our system has got a maximum drawdown of minus 12%. The buy and hold maximum drawdown is a whopping minus 55%. Okay, so our system is giving us a risk adjusted return of 28%. Whereas the buy and hold risk adjusted return is only 10%. So what this really means is, what we can really say from this is, yes, our trading system hasn't produced the same profit as buy and hold, but on a risk adjusted basis, it's done a lot better. So if you were to use a bit of margin, you can boost these returns, or you could use a leveraged ETF, or you could use CFDs or futures. You know, we've got a 75% win rate here, a very small drawdown, and the risk adjusted return is getting on to 30% a year. So once you introduce those enhancements, then this system does look favorable to a buy and hold approach. Of course, this is just a back test, doesn't tell us what's going to happen in the future. And this is just an idea for you to look at home and work on yourself, see if it's something you might want to use. So here we've got the profit table for our system as well. You can see we've got mostly positive years. System actually did its best between 1995 to 2000, but it has had good years since then. 2009, 2016, 2012. Not many down years and only very small down years, so that's a good sign. Now, what can we say about this system? Well, it's a very simple strategy that takes chunks out of the main trend, but no system is guaranteed to work, as we've said. But this one does show some nice characteristics. It's got a high win rate with a short holding period, and it can also work well with walk forward analysis. So one idea would be to use this on SPY, or well, you could actually use this on absolutely anything. So you could use this on individual stocks, futures, leveraged ETFs. You could run an optimization, say over 5 years, walk forward it for 1 year, do that walk forward analysis to find out the best settings that works for that particular time period and security. Okay. So as I've said, performance could be enhanced with use of margin, trading futures or CFDs. You could also introduce, of course, more complex rules and use some discretion in your trading. So for me, this is a good system when you do have a fundamental view of the market you want to trade and you want to take chunks out of that trend. So for example, if you've got a good fundamental view that you think Apple is in a bull market, but you don't want to just buy and hold, you want to get in and take chunks out of that trend, this is a great strategy to do that. Okay, so that's today's trading strategy. For more advanced trading strategies and ideas, you can visit our website at jbmard.com, research.jbmard.com for all of our advanced trading strategies. All right, that's it for now. Cheers.